Good morning, viewers. I'm Shalini Gera, Certified Financial Planner and Principal Officer at Provitt Consultants. We bring to you the annual market outlook session for 2025 and the outlook for 26. In today's session, we would be covering three key points. Number one, how did the equity markets behave in 2025? Number two, how is 2026? What is 2026 expected to bring to the table in terms of various asset classes? And number three, how should investors be positioning their portfolios to take advantage of the opportunities that are being presented to you in the current year? So stay hooked to the session till the very end as I talk about important asset classes that you're holding in your portfolios, including equity. Within equity, we talk about the large caps, mid caps, small caps, and finally the elephant in the room, which is also the gold and silver, the rally that happened, the massive rally, and then the corrections that followed. So without much ado, let's get started. Today's flow of the session will be covering the session within the next half an hour, and the last 5 to 10 minutes we will keep for questions and answers. You are more than welcome to put all your questions. We can see them in the form of comments, and we will attempt to answer them as much as possible. Satya, over to you. Next slide, please. So 2025 was a classic example of a seesaw. Markets were extremely choppy. In February 2025, we saw the mid and small caps correcting heavily. They corrected as President Trump had come to power in the US and lashed the world with heavy tariffs. Then once again in May 2025, and Satya, you could circle these points that as I talk about, so viewers are very clear which points am I referring to in the graphs. May 2025 once again saw a correction in the Indian equity markets as we saw the India-Pakistan conflict come to rise. This was followed by various defense stocks rising and reaching extremely high valuations. Then once again in September 2025, we saw some good highs in the markets. And this happened as the government announced GST rate cuts and gave a massive amount of liquidity to consumers to be able to consume as well as to invest. Here we are in January 2026. We are once again at Sensex 83,000 level. And this looks like a 6% recovery from where Sensex was last 1 year. Satya, could you move to the next slide, please? So if you look at the various market capitalizations, and these are various market caps that you hold in your portfolios, Nifty, which represents the top 50 stocks in the large cap index, has given a 6% return in the past 1 year. But when you look at the November 24 to November 25 period, it is at exactly the same level, which means that there is a 1 year, not a price correction, but a time correction over there. Coming to mid caps have also seen a negative 0.6% correction from the past 1 year. Small caps have seen the heaviest brunt in the equity markets, and I will explain the reason as to why small caps corrected the most. They have seen the maximum correction of 8%. Now, let's talk about a bit about why all of these market caps corrected the way they did. So, let me give you some information about the foreign institutional investors' flows that happened from the markets. So 2024, if you remember 2024, that was a year when Indian equity markets were making headlines. We were one of the best performing markets globally, and Indian equity markets had given a 22% CAGR, and this was coming from just the large caps itself. So FIIs who had invested in the beginning of 2024 decided to book these profits that they had obtained from the Indian equity markets, and they started searching for lower valuation markets. We'll talk about what these lower valuation markets were. So FIIs booked these profits. They decided to move out of the Indian equity markets and they moved to the lower valuation markets. And this brunt of the outflows was largely from the large cap space. So the large cap space saw an outflow of 1.5 lakh crores purely coming from FIIs. But in spite of this outflow, Sensex not just remained where it is, but it managed to reach the levels of 83,000 from the bottoms of 72,000. So why did that happen? This is because DIIs, domestic institutional investors, pension fund managers, insurance fund managers, mutual fund managers, they decided to put in the liquidity of 8 lakh crores. Now, where did this 8 lakh crores come from? They came in from the monthly SIP inflows that you and investors like you and I continue to pump in. We are pumping in nearly 30,000 crores of an SIP book, and we are giving these to the domestic institutional investors, and they have no choice but to invest in the Indian equity markets. And they are investing in the space from where the FIIs moved out, creating valuations. So that is why the large caps, they managed to hold their places. Now let's talk about why the correction happened from the mid and small cap space. Apart from the SIP book that investors are pumping into the markets, FDIIs, the domestic institutional investors, also decided to book the profits that they had made from the mid and small cap spaces in 2024. So DIs are positioned in the form of flexi cap funds and large cap, mid cap, and small cap. So the profits that they had made in the mid and small cap space, they decided to book those profits and they decided to shift them to the large cap space where they got a better valuation. And that is why, my friends, we saw a heavy correction happening in the mid and small cap space and not as much in the large cap space. Satya, moving to the next slide, please. Now, whichever meeting I am in, I tend to get investor concerns about valuations, that the mid and small cap valuations are still high. Here is the data presented in black and white in front of you. Look at the valuations that are commanded by the large cap space. Nifty 50, which had a median PE of 22, has now corrected to 21. You can see the correction that has happened in the price to earnings ratio. It is available at a 22. Let's look at the valuation of mid cap index. In the mid cap index, the median was 33. It has now come down to 31. The high was 42 in the past 1 year. In the small cap space, the median PE was 28 and the current PE is 27. Clearly talking about some reasonable valuations. From no angle are the mid and small cap space undervalued, which makes them excellent spaces to look at from an investment point of view. Investors must maintain reasonable amount of systematic investments. These could be STPs, these could be SIPs, but mid and small cap space should definitely form a part of investors' portfolios through SIPs and STP as per the individual's financial goals, risk appetite, and return expectations. Satya, move on to the next slide, please. Let's talk about which sectors took the highlight in 2025. So metals, auto, and financial services were the clear outperformers. I'll explain the reasons for each. So metal was largely given the benefit of the rally that happened in gold and silver. Gold came into demand because of our festive season, because of the rally shown by investors, because the equity markets were not moving. Silver got the benefit of the industrial demand as well. Industrial demand due to its demand in solar cells, electric vehicle cells, electric vehicle batteries. And apart from just gold and silver, we also saw rallies happening in the copper and platinum space. Uh, Apart from their industrial usage, these metals, specifically copper, silver, they also saw some applications happening in the infrastructure space. So, because the infrastructure development was huge, we saw developments of roadways, development of highways, development of seaports, airports. That was also one factor which gave the metal sector a huge rally in the past 1 year. Then auto sector got the benefit of the GST cut that the government decided to give us in the month of September. So September to December was one period in which automobile stocks rallied, automobiles showed good corporate earnings as investors tried to take the benefit of the GST rate cuts and move to more premium vehicles, thereby driving the sales and corporate earnings of automobile companies. Financial services got the benefit of three, four factors. Number one, the credit quality that has come, that is now with the various banks, public sector as well as private sector banks, that is excellent. Number two, there has been a good credit uptake, which means consumers are applying for a lot of loans. This happened largely due to the repo rate cut and the tax benefits that were given by the government in the previous financial year. And finally, the repo rate cut, which had also happened. The repo rate cut also gave banks and financial services a push by lowering down loan rate cuts. Another factor that was responsible for financial services improving was the GST rate cut, which directly made insurance policies cheaper for consumers to buy. Moving on to the worst performing sectors. So, realty, IT, consumer durables got the worst hit of the previous year. Realty largely. So let's talk about where does realty get its demand for. So when in top tier cities, including Delhi, NCR, Bangalore, Hyderabad, these are large IT employee hubs. So when job cuts happened in a lot of multinational companies driven by the demand in artificial intelligence, uh, IT people, IT employees lost their jobs and stopped looking for homes as much as they were in the previous years. This was one reason why a lot of reality stocks got the hit, fell down by negative 17%. IT got the hit when President Trump announced the H-1B visa bans. People immediately, for although this was more of a myth, this was a good opportunity to consider last year. This is because it was a myth that Indian IT companies are going to get the brunt of the H1B1 price hike. This was actually not true because most H1B visa consumers are actually global companies, American companies, including Meta, Microsoft, Google. These companies are responsible for paying for the visas of Indians who are responsible for going abroad. But because the hit was not borne by the Indian IT companies as such, IT stocks quickly rallied from their correction points as well. So that was a good opportunity to consider for financially strong IT companies in India. And then third sector that took the hit was consumer durables. This largely happened because consumer durables, including um, your air conditioners, refrigerators, they tend to use imported compressors. And these imported compressors took a price hike. The input cost rose for consumer durable companies, which was directly passed on to the consumers. Demand fell, corporate earnings fell, and hence the stock prices also corrected. Moving on to the next slide, please. Hmm. So year 2024, India was the best performing market. This was followed by FII outflows, which led to the Indian markets being the worst performing markets. You can see the FII flows moved on to countries including South Korea, South Africa, Brazil, Germany, Europe. And the worst returns were given by markets including India, China, as well as US, from where the flows actually moved out. These became overvalued markets in 2024. So flows moved out into undervalued markets, which then got the benefit. Next slide, please. So let's understand the MSCI Emerging Market Index as the FII outflows happened from the Indian markets as well as some of the emerging markets. India's share in the MSCI emerging markets went down from 20 to 15% from May 2024 to November 2025. However, we still occupy nearly a 16% of composition in the MSCI emerging market index. Let's understand how this index works. Whenever FIIs are supposed to invest anywhere, they don't invest in a country's individual stocks. So they're not going to start picking up stocks in India to invest in. They invest in an index level, which is the MSCI Emerging Market Index. And since we occupy a 15% allocation in this index, this means that whatever flows FIIs will start putting in the emerging markets, we will automatically get the benefit of 15% of that allocation. So this is no rocket science that FII ownership clearly fell down from a high of 17% to 15% in the Indian equity markets. Next slide, please. Why FII sold Indian equity markets? One important reason that we have already talked about was the high valuations that the Indian markets commanded. Secondly, Indian macros and currencies also came into a pressure because the Indian currency was allowed to free fall, and it's now under a lot of pressure. It's come down to about 91.7. This is a factor that a lot of short-term FIIs tend to look out for. See, FIIs are investing in dollars, so their main currency is dollars. This gets converted to INR, and this gets invested in Indian stocks. So when INR is in a lot of pressure, this means, and INR is depreciating against US dollar. This means that the gains that FII markets are actually this means that the gains that FII markets are actually getting from the Indian markets, they tend to get nullified, or they tend to get negated with the INR depreciation. This is why our currency being allowed to remain stable is a very important factor for FIIs to come back to India. Next slide, please. So this was what has happened in 2025. Let's talk about the bad part is over. Let's talk about the good part that is yet to come. The government has taken a lot of steps in the previous financial year in order to give a boost to our economy. And when the economy gets a boost, the markets, which are a direct mirror of the Indian economy, can't be far behind. So the government gave us the troika, the tax troika last year. The first one was the GST rate cut, massive rate cuts happening across products ranging from automobiles to food products, driving mass consumption, and that benefit also coming to us in the form of GST rate cuts, entire zeroization of GST on various life insurance as well as health insurance policies, done entirely to drive consumption. When consumption happens in a large way, this is automatically going to result into corporate earnings, which will result in the recovery of the markets. The second benefit that the government gave us FY-25 was the direct tax slab change. As the tax slabs were reduced, the Indian consumers got a benefit of more than 1 lakh crore, which could directly be consumed, which could directly be invested in the markets. Next slide, please. The final hit which was given by the government, the benefit that was given by the government, was the repo rate cut. We got the advantage of 125 basis points of a rate cut. This was entirely front loaded, which means that it was entirely given to us in the beginning. So this repo rate cut ensured that we are now looking at a repo rate of 5.25%. This has also translated into loan rate cuts directly for consumers. So in the month of December itself, we have seen the data that home loans, education loans are being priced cheaper by both private sector as well as public sector banks. And this is directly going to give a benefit to consumers who want to take up more loans for buying their houses. Next slide, please. So Indian macroeconomics are not bad at the moment. You can pick up whichever macroeconomic factor, and it looks very comforting. So India continues to be one of the fastest growing economy in terms of the real GDP growth rate. Real GDP stands at 7.7%. The inflation has been managed well. We have a target range of 4 to 6%. We are looking at inflation slightly lower than that level at a 0.7%. It is important for this inflation figure to go back to our target range of 4 to 6%. This is important because if we have to become the second or the third largest economy in the world, then the factor that we should be looking at is not the real GDP, but the nominal GDP, which is the addition of the real GDP and the inflation. We need to be growing at a nominal GDP figure of 10%, 11%, which is currently only at 8.4%. This is precisely why, in order to drive inflation, the government has given all of those tax rate cuts that we just talked about. So once the tax rate cuts actually transfer into demand in the economy, the inflation levels will slightly go up and will translate to a better nominal GDP picture that we really need. Brent crude price, we are 80% importer of Brent crude. Brent crude is at sustainable levels of 63. INR depreciation. So the government has actually allowed the INR to fall and has not really interfered in the protection of INR against dollar. This is also important for one reason. This is important because India is not just an Atmanirbhar Bharat, but we also have to become a an export hub. So India has not just started manufacturing semiconductors in 2026, but we are also going to start export of these semiconductors very soon. Uh, Exports of pharmaceutical products, exports of IT services are very important, because as exports grow, our fiscal deficit continues to be in control. So this is one reason why INR depreciation isn't exactly a very bad factor for the Indian economy. Next slide, please. Our service exports have seen one of the fastest growth across various economies. We continue to grow at 12% in terms of our services exports. Our share in the world services exports have gone up from a 2% to a 4% in 2023. Next slide, please. This is another interesting slide, an interesting data point, which talks about the premiumization of various products. Two classic examples that I would like to give to you. So, a lot of consumers, instead of preferring mass built cars, are now moving on to SUVs. This is a classic example of premiumization driving corporate earnings. Then, a lot of households have stopped utilizing soaps and instead have moved on to body washes. Another example of premiumization. So, if you look at the graph on the right hand side, the trends in consumer spending, you can see that the non-discretionary spending, which is actually the premium spending, has moved up from this is actually the I'm sorry, the discretionary spending. The discretionary spending represents the premium spending, which is actually moved up from a 38% to a 53%, signaling the rise in discretionary income, in disposable income, in disposable surplus, and the want and the urge to buy more premium products. The bottom graph also gives the rise in the percentage of premium cars as a percentage of passenger vehicle sales. This has moved up from 21% to a 65% now. Next slide, please. So what happens as a function of all of that tax boost, tax rate cuts that the government has given to us, and the premiumization that has happened? We are looking at a better Nifty 50 EPS growth. So if you look at the FY26 earnings, which will end in this year, March, FY26 earnings are expected to be 8.7%. But if you look at the forecasts in 2027, 2028, see, the measures that the government have given to us are long-term measures. Those aren't exactly short-term measures, which is why the impact isn't seen in corporate earnings in 26, but is more significantly visible in earnings of 27 and 28. We are expected to grow at a Nifty 50 earnings per share rate of 16% and 15.7%. This is directly going to result into a stock market mirroring this growth, which means that we can soon start expecting double-digit growth coming from the equity markets as well. Next slide, please. So the talk of the town, the gold and silver. Every single meeting that I am in, how much gold do we have in our portfolios? Should we start building more gold SIPs? Should we take up silver in bullion or not? So let me answer these questions now. Gold and silver have seen a massive rally in 2025 and 26. Look at the appreciation that has been given by gold in 25. That was 75%. Another 11% in 2026. So we are looking at gold rising by nearly 85% in just the past 1 year and 1 month. Let's look at the rally which has happened in the silver space as well. Next slide, please. Yes, thank you. So this is even more astonishing. So 2025 silver has given a 183% return, and 26 34% return. Why did this happen? So this has happened primarily because of three reasons. Let's talk about gold first. So whenever geopolitical geopolitical turmoil is high around us. So in 2022, we saw the Russia-Ukraine war. 24, 25, we woke up to the Israel and Hamas war. 25, we woke up to President Trump lashing tariffs against the world. This leads to a lot of global uncertainty. So individual investors, they start pulling out of the equity markets and deploying whatever liquidity they have, whatever profits they have booked, whatever surplus liquidity they have, they start putting them into more safer classes, safer safer haven. So gold is a classic example of a safe haven, and that is why gold got the benefit of profit booking and geopolitical turmoil happening around the world. Secondly, and this is quite interesting. So in 2025, the Russia-Ukraine war was not coming to an end. Now, Russia tends to have about $600 billion of reserves in gold and foreign currency. What did US and Europe decide to do about that? So, Europe and US, they decided to freeze these assets for Russia, and they wanted Russia to utilize these assets to pay for the damage that happened in Ukraine. So all the central banks around the world, they thought, what if US does that to us sometime? So let's not have our reserves in US dollars, but rather start building up gold reserves, which US has absolutely no control on. So central banks around the world have started piling up on gold reserves. Look at India; it is now having 880 metric ton of gold reserves, nearly the eighth largest across the world. And the third reason for gold rallying is the fact that the rates were coming down globally. So, when rates are coming down, traditional bank deposits do not look very appealing and attractive to investors. This is why investors start flocking to gold, which again looks like a safe haven to them. Silver naturally got the industrial benefit, the industrial demand benefit. So, not just was there a demand for consumption in terms of jewelry, but also because of its requirements in solar cells and electric vehicle batteries. Next slide, please. Okay, just go back to the previous slide. So, I want to talk about the rally, whether this rally is expected to continue in 2026 or not. See, as we talked about geopolitical situations, as long as geopolitical situations tend to surround us, we will continue to see some demand in gold and silver as long as the war between uh, Ukraine and Russia continues, as long as the war which is happening in the Middle East continues, as long as uh, Trump talks about acquiring Greenland, although there is some still question mark over there because the November elections will also happen, and it does not look like Trump is going to get another continuation of a term over there. So, as long as these geopolitical factors will continue, there will be some demand for gold. And we talked about the industrial demand for silver that is going to continue. Analysts around the world have given higher forecasts for gold and silver. Gold, which is at about 5,100 US dollar per ounce, is expected to hit 6,000, 5,500, 6,000 by the end of this year. Silver, which is at about 110, is expected to hit 150. So it looks like there may still be some rally, which may be left in gold and silver. However, one thing is very, very clear, and move on to the next slide, please. And here I'm coming to the uh, portfolio framework that investors should have. So, one thing is very clear that there is absolutely no substitute for the companies which are driving the growth of India. So the large cap, mid caps, and small caps should continue to be a part of investors' portfolios in the largest ways. For aggressive customers, we recommend that equity portfolios should command as much as 80%. And depending upon your financial goals and your risk appetite, you have to decide, or your financial advisor will decide, what is the best allocation between large caps, mid caps, and small caps. We still recommend that you continue to hold 10% in the form of gold and silver, exactly for situations that we saw in 2025 when equity markets do not perform. That's a time when gold and silver continue to rally. So a 10% allocation in gold and silver can be held in your portfolio, and this should be held not in the form of lump sums but systematically, and also through multi-asset funds, which give you the advantage of diversification between debt, equity, gold, as fund managers see more valuations, better valuations, and better demand for commodities or precious metals, they will automatically shift some profits and it will increase allocations in gold and silver. You do not have to time the markets, and you certainly do not have to pay any kind of exit loads or taxation due to profit booking. Uh, let's talk about the equity space now. Let's talk about what is expected to benefit in terms of large cap, mid caps, and small caps. So, large caps have got some benefit of the domestic institutional investors putting in funds. This year, we clearly expect mid and small cap funds, mid and small cap stocks to be outperformers. And I'll give you the reason. If the US and India trade deal is to happen, even if the trade deal does not happen, we expect that some sort of a positive framework will be signed during the year. This is because US is an important buyer and an important consumer. It is the world's largest consumer. So if we have to uh, reach our ambitions of becoming the world's second and third largest economy, $5 trillion, $7 trillion within the next few years, US clearly has to be on our side. US has to be an ally. We need to have some sort of a positive framework with US. It is also already expected that the 25% tariffs for buying Russian oil will largely be scrapped off in the coming few months. So as the India and US trade deal gets signed, that is one factor that FIIs are waiting for. As that deal gets signed, FIIs will start coming back to India. We already have sustainable valuations. As FIS come back to India, they are going to come back in the large cap space, which means that the large cap valuations will rise, and the domestic institutional investors who invested in the large cap space during last year, and those domestic investors or those domestic institutional investors who are present in the large cap, mid cap, and small cap space through flexi cap funds, they will book profits from the large caps and they will once again move to mid and small caps, driving profitability in those market capitalizations. And when the mid cap and the small cap stocks recover, that recovery is automatically more sharper as compared to the recovery that happens in the large cap space. This is because mid and small cap companies are smaller companies and they tend to compound, they tend to grow their corporate earnings at a much faster pace. We also recommend that investors should have a 10% allocation in the global asset space. This is recommended, one, on the backdrop of the artificial intelligence rally. Secondly, you will be investing in the currency of US dollars, which means that you directly get the benefit of the US dollar appreciation against INR. And number three, it gives you a very good diversification during the long term. If there are years when the Indian equity does not perform, we have seen that US economy or US markets have performed slightly better. This is because of the low positive correlation that is there between India and the US market. When Indian markets are performing to a slight extent, US markets perform to a larger extent because of the lower positive correlation. Is there anything else that we have left, Satya?
No, ma'am.
Great. So this brings us to the end of our discussion. We are now open to questions and answers. Okay. So Nikhil Sadanand is asking us what are the ways of investing in the semiconductor manufacturing companies in India. Nikhil, one, if you are looking at buying individual stocks, if you're looking at buying individual stocks, first of all, I would recommend that you should have a good in-depth knowledge of studying the fundamentals of the stocks. We should not just be going for semiconductor companies just because India is becoming a manufacturing and export hub, but we need to identify companies with strong balance sheets, companies with attractive valuations, and companies with strong technicals as well. So Darpan is asking, can we expect one more crash in gold and silver in next week or so? So Darpan, would be very difficult to point out a correction happening in a short space. But let me share some interesting data points with you. Satya, if you could just go back to the corrections or the returns that have been generated by silver during the past 15 years. Yes, thanks. So Darpan, this is the past 15-year performance of silver, and you can see that these past 15 years, whenever we got a rally, That rally was followed by a very sharp correction in not just 1 year but for 3 years. So look at 2012, when silver gave about 12% returns. It was followed by a negative 27% return in 13, another 17% negative return in 14, and another negative 7% return in 15. Then look at 2016, 17, we had a rally, and then 2018 was one full year of a correction, and then 2019-20 was a rally. 2021 was again a full year of correction of 10%. So because silver has already rallied so massively, it looks like a strong correction is around the car is around the corner. I'm not sure when it could happen, but it could happen anytime soon. Let me also give you the reason as to why the correction happened yesterday. Silver fell by as much as 15% in a single day. This happened as we got the announcement of the new Fed governor, who is Kevin Warsh, who is expected to be hawkish in nature. So it looks like he may not cut down rates as much as the predecessor had done. When the rates do not come down, when the rates are maintained at a good level, investors tend to find comfort in bank deposits rather than moving to gold and silver. That and then the profit booking happened after the rally. So these are the two factors that were responsible for the correction. Further corrections could always be on the corner. We may just as well have a year which is entirely negative in this year. Yes. So Nikhil Mathur asks, we are good for an optimistic approach in the market, but as mentioned in the recent economic survey report, there is a 10 to 20% chance of a crash. What would be our strategy to manage that? Nikhil, we are well prepared in our portfolios to manage corrections. Yes, due to the global events, due to the global slowdown, it is although Indian fundamentals are very strong at this point, ultimately Indian markets are also dependent upon global markets. They also relay the same sentiment. So if there is a global slowdown, if the global pressure continues, then we may look at another correction in our markets that we saw in 2024. So in 2024, we saw a 15% correction happening in just the large cap space, and you would remember that in our portfolios we maintain at least 10% of an allocation in hybrid mutual funds, which have 50 to 60% composition of debt mutual funds. So as long as you are a long term investor, as long as you continue to have a high risk appetite, long term financial goals, those 10 to 20% corrections should be utilized as opportunities. You should not panic from those corrections. You should utilize as opportunities, and you should shift the hybrid positions that you are holding in the equity space, which means that you are buying equity at lower prices, lower NAVs. And as markets recover during the long term, you will naturally see the benefit of you buying stocks at lower prices, you buying mutual fund at lower NAVs. We saw in 2024, wherever we bought uh, mutual funds at a low of 72,000, 75,000, we were able to give investors the benefit of 15% of a recovery as the market slows. So that is how we will utilize correction periods. And as we are recommending that 10% should also be held in gold and silver through multi-asset funds. So in the event of a correction in equity markets, gold and silver will also provide diversification and comfort. Hmm.
Uh, Ma'am, one of the viewer wants to know about the your opinion on defense sector, especially with the domestic companies moving in this space.
Yes. So, defense is an important space for us, and we have seen massive rallies happening in the defense stocks, including Hindustan Aeronautical, Bharat Electronics Limited. Please note that these are not stock recommendations. I'm only talking about facts and figure. So, a good rally has already been seen in defense stocks from, I would say, about April 2024 till 25. The problem with these certain defense stocks is that while the financials may be very strong, the valuations are abnormally high. And when valuations are abnormally high, either you may see a price correction such that the price is justified as per the corporate earnings, or you may see a time correction, which means that there is no upside, the stock price remains where they are. So I would not recommend investors to start looking at defense stocks per se, especially if at all you are looking at defense stocks, please go by your research. Please go by research of strong balance sheet, good valuation available, and a strong momentum as well. Otherwise, those stocks should not be considered. Otherwise, defense continues to play a good have a good play in the long term growth story of India. We continue to have a 3 to 4% of an allocation of our GDP in defense as well, which is also going to be maintained in the next budget as well. So, from a long term perspective, when you have a good 5 to 7 year horizon, defense stocks, I'm repeating, defense stocks available at a good valuation, they can be a part of your portfolio.
Uh, Moving to the next question, ma'am. INR depreciation good for mutual fund performance?
See, INR depreciation for domestic mutual funds does not have too much of a role play because we are investing in INR and we are getting the returns in INR. Uh, INR depreciation works for global mutual funds, one. So, when you are investing in global mutual funds or global stocks, you are essentially your primary currency is INR, which gets converted to US dollar, and that gets invested inside the stock. So when you get the return of the global stock along with the depreciation. So INR depreciation will benefit to you when you are holding global stocks. This is one. Secondly, INR depreciation is fundamentally important to our economy because we are a services export oriented economy. So it is very important for the export sector. Giving you a classic example, we are manufacturing large quantum of iPhones in India and we are exporting them as well around the world. So assuming that $1 is equivalent to 100 INR. So an iPhone which cost 1 lakh rupees will be equivalent to $1,000 today. So if INR depreciates further, then the same iPhone which is costing $1,000 today will cost $999. That is, it will cost lesser to importers. So this is excellent for imports. Importers would want to bulk up or build up on their imports as INR depreciates. So this is exactly why the government is not stepping in too much to control our currency, because we also have to start working on our exports of defense as well as exports of semiconductors. So it is important that INR depreciation happens to a certain extent year on year. It is very important to our economy. It is not beneficial for FIIs. FIIs look for a strengthening INR because FIIs are converting their currency from US dollar to INR. They look for a strong INR. So if so there has to be a good balance in the depreciation of a currency. If the right or optimum balance is maintained, then FIIs will also continue to invest in India, and our exports services will also continue to get the benefit of the depreciation.
Okay, ma'am. Moving to the next question. Somebody has invested in gold ETF and silver ETF. There was a correction in both yesterday.
Yeah.
What should they do now? Stay
Mhm.
invested or partially book the profit or take an exit?
See, gold and silver are long term plays. They are not short term trades. So do not expect benefits to come from your gold ETFs and silver ETFs within the next couple of days or couple of months. Diversification in your portfolio is important because of the industrial demand, because of the imports of gold and silver ETF prices. They will continue to rally in the long term. So, if you have bought a good level of gold and silver, I recommend that up to 10% of your portfolio they can be maintained.
Okay. Ma'am, just last question. What can we expect from budget 2026?
So, in budget 2026, one, we expect that something may be done about the import duties on gold. We are largely dependent on gold imports for our requirements of jewelry consumption. You know the love of Indians for gold. We continue to build up our imports, and that affects our fiscal deficit. So it is important that something needs to be done about the gold import duties, so that investors who are flocking into gold ETFs control their urge to invest in gold. This will not deter the buyers for consumer jewelry, but this will definitely deter investors for investing into gold. If the import duties rise, then there will be some cooling of demand in gold, which means that our fiscal deficit continues to be maintained as per our expectations. Then we also expect 3 to 4% of an allocation to defense sector, as we need to become an Atmanirbhar Bharat, and we are also looking at defense also becoming export oriented. So we will see some allocations around that. The old regime is largely going to be eliminated in the long term, so we may see some more benefits coming in the form of individual, something more about the deductions, or something more on the uh, tax slabs, some differentiation in terms of making the old regime more redundant and less beneficial. Something may also be done around that.
Ma'am, we have answered all the questions. Now we can wrap up this session.
Done. Thank you very much, investors and viewers, for giving us this precious 1 hour in an early morning on a Saturday. We will continue to work with you and give you more insights on economy and markets in our next upcoming sessions. Thank you. You have a great weekend ahead, and bye bye.